Did you know your Empower 401k could be quietly siphoning away $75,000 or more of your retirement savings without you ever realizing it? This isn't some conspiracy theory. It's the insidious reality of hidden fees and suboptimal choices that plague many employer-sponsored plans. Imagine starting with $50,000 in your account at age 30, contributing $6,000 annually, and earning a hypothetical 7% return. If just 1% in extra fees is deducted each year, by age 65, that small percentage point could mean losing over $75,000 in potential growth. That's a significant chunk of your golden years, gone before you even see it. Most people don't even know these fees exist, let alone how to find them. But uncovering this secret is easier than you think. And it starts with knowing where to look inside your Empower account. The first step to safeguarding your retirement is to identify the fees hiding in plain sight. With Empower, you'll typically find these details within your quarterly statements or by logging into your online account and looking for documents like the 401k fee disclosure or plan summary. Don't just skim it, dig deep. You're looking for administrative fees, record-keeping fees, and especially expense ratios for each fund you're invested in. For example, if you're in a target date fund with an expense ratio of 0.75%, that means 0.75% of your investment's value is deducted annually, regardless of performance. Compare that to a similar index fund with a 0.05% expense ratio, and suddenly, the difference becomes stark. We're talking hundreds, even thousands of dollars annually, which compounds into a massive sum over decades. But what if your plan offers funds with even higher fees? That's where the real damage can accumulate. Expense ratios are the single most critical fee to understand. These are the annual costs charged by the fund manager, expressed as a percentage of your investment. A seemingly small 0.5% difference can be catastrophic over 30 years. Let's say you invest $10,000 in two different funds, both earning 8% before fees. Fund A has a 1.2% expense ratio, and Fund B has a 0.2% expense ratio. After 30 years, assuming no further contributions, Fund A would have roughly $76,000, while Fund B would have over $100,000. That's a $24,000 difference from just one initial investment, multiplied by every dollar you contribute over your career. Empower, like many providers, offers a range of funds, and it's up to you to pick the low-cost options. But identifying the best funds isn't always intuitive, especially when there are so many choices. Many people are automatically enrolled in target date funds, which seem convenient. They adjust their asset allocation as you get closer to retirement. However, not all target date funds are created equal. Some carry significantly higher expense ratios than a DIY portfolio of low-cost index funds. You might be paying 0.7% for an Empower target date fund, when you could build a similar diversified portfolio with individual Vanguard or Fidelity index funds for 0.05% to 0.15%. That 0.55% difference might seem trivial, but it can easily cost you an extra $50,000 over a career. The common mistake is assuming that set it and forget it means it's automatically optimized. It rarely is. Always check the underlying funds within your target date option and their individual expense ratios. But what if your Empower plan doesn't offer good, low-cost options at all? That's a different problem entirely. Sometimes the biggest challenge isn't identifying fees, but realizing your Empower plan simply doesn't offer truly low-cost, diversified index funds. Many employer-sponsored plans have a limited menu of investment options, some with higher expense ratios because the employer chose them. If your plan's cheapest S&P 500 index fund still has an expense ratio above 0.2%, you're likely overpaying. For context, you can easily find S&P 500 index funds outside of a 401k with expense ratios as low as 0.03%. If you find yourself in this situation where your plan's options are subpar, you might feel stuck. But there are still proactive steps you can take to mitigate the damage, even if you can't completely control the plan's offerings. One crucial action is understanding what to do once you leave that employer. This is one of the most powerful moves you can make. Rolling over your old 401k from a previous employer into an individual retirement account, or IRA. When you leave a job, you gain the freedom to move your Empower 401k balance into an IRA at a brokerage like Fidelity, Vanguard, or Schwab. This is where you unlock access to an almost unlimited universe of low-cost ETFs and mutual funds, often with expense ratios significantly lower than those offered in your old 401k. Imagine switching from an old 401k with an average 0.8% expense ratio to an IRA with a 0.05% average. On a $100,000 balance, that's saving $750 per year, which compounded over decades can mean tens of thousands extra in retirement. Failing to do this is a common mistake that costs Americans dearly. But there are different types of IRAs, and choosing the wrong one can have tax consequences. When considering a rollover, you'll face the choice between a traditional IRA and a Roth IRA. This decision impacts when you pay taxes and is crucial for maximizing your long-term wealth. If your Empower 401k was a traditional 401k, pre-tax contributions, you can roll into a traditional IRA without incurring taxes. This keeps your money growing tax-deferred until retirement. However, if you believe tax rates will be higher in the future, you might consider a Roth conversion, moving your pre-tax 401k money into a Roth IRA. This means you pay taxes on the converted amount now, but all future growth and withdrawals in retirement are tax-free. For example, converting $50,000 might mean a $10,000 tax bill today, but could save you $30,000 or more in taxes decades from now. The decision hinges on your current and projected future tax brackets. But what if you're still with the employer and can't roll over your active 401k? Even if you can't escape your current Empower 401k as limited fund options, you can still maximize its potential. First, always contribute at least enough to get your employer's full match. This is free money, often a 50% or 100% return on your contribution, which you simply cannot pass up. If your employer matches 4% of your salary, contributing anything less is leaving money on the table. For someone earning $70,000, that's $2,800 annually in free money. Second, consider contributing the maximum allowed by the IRS if you can afford it. For 2024, that's $23,000 or $30,500 if you're age 50 or older. Even with higher fees, the power of tax-advantaged growth and dollar cost averaging can still build substantial wealth. But there's a common psychological trap that prevents many from saving enough, focusing on the present over the future. A common psychological myth is that our future selves will somehow magically have more money or be better equipped to save. This often leads to procrastination, a critical mistake costing people hundreds of thousands. The truth is, your future self is simply your current self, just older. The earlier you start, the less you need to save each month to reach your goals, thanks to the magic of compound interest. If you start saving $500 a month at age 25, you could have over $1.5 million by age 65, assuming 8% annual return. If you wait until age 35, you need to save almost $1,200 a month to reach the same goal. That's more than double the monthly commitment. Don't let the future self myth trick you into delaying. The most powerful tool for retirement saving is time, and you're losing it every day you postpone. But there's a specific type of contribution that adds another layer of tax advantage. If your Empower plan offers a Roth 401k option, seriously consider it, especially if you expect to be in a higher tax bracket in retirement. With a Roth 401k, you contribute after-tax dollars, meaning your contributions don't reduce your taxable income now. However, all qualified withdrawals in retirement are completely tax-free. Imagine having $1 million in your Roth 401k at age 65 and being able to withdraw it all without paying a single dollar in taxes. This can be a huge advantage, especially if tax rates rise in the future. For someone in the 22% tax bracket today, Contributing to a Roth 401k means paying taxes on that income now, but potentially saving 25% or 30% or more on withdrawals later. It's a powerful tool for tax diversification, offering flexibility when you need it most. But what about when the market gets volatile? One of the most destructive mistakes investors make is panic selling during market downturns. Seeing your Empower 401k balance drop can be terrifying, prompting some to sell their investments, locking in losses, and missing the inevitable recovery. History shows that markets always recover. During the 2008 financial crisis, the S&P 500 lost over 50%, but those who stayed invested saw their portfolios rebound, and then some. For example, if you had $100,000 invested and the market dropped 30% to $70,000, selling then would cement that loss. But if you held on, or even better, continued contributing, you'd be buying more shares at a discount. When the market recovered, your $70,000 would grow back to $100,000 and beyond, often much faster than you'd expect. Investing is a long game, and emotional decisions are usually bad decisions. Stay disciplined, even when it feels uncomfortable. But how do you even begin to track all of this? The final crucial step is to regularly review and rebalance your Empower 401k. This isn't a set it and forget it situation. At least once a year, log into your account, review your investment performance, check your fund's expense ratios for any changes, and ensure your asset allocation still aligns with your risk tolerance and timeline. Life changes, you might get a raise, or your risk tolerance might shift as you get older. Rebalancing means adjusting your portfolio back to your target percentages. For example, if your stock allocation grew from 70% to 80% due to strong market performance, you might sell some stocks and buy more bonds to get back to 70/30ths. This helps you manage risk and ensures you're not overly exposed to any one asset class. A simple annual checkup can prevent significant drift and keep you on track. But remember, the goal here is not just growth, but controlled growth. Taking control of your Empower 401k means being proactive about fees, understanding your fund choices, and leveraging tax advantages. That potential $75,000 loss isn't inevitable. It's preventable by applying these strategies. If you're wondering how to properly diversify your portfolio beyond just your 401k to maximize returns and minimize risk, watch our video on the 3-fund portfolio strategy you need. It covers how to build a simple yet powerful investment portfolio. Don't forget to subscribe for more personal finance insights that can truly transform your financial future.